Fine. Good to see you.
It's always a pleasure, always a treat. I know folks are joining over the next 30 seconds or so. Um, and we're broadcasting on LinkedIn and YouTube and Twitter. And this is one of our experiments to just bring in incredibly sharp, thoughtful people and share perspective with the broader audience. When I'm on a phone call with someone, I often think to myself, gee, I wish I could just take that conversation and publish it to the world. So in a way, what I'm doing here is just trying to share the perspectives and the conversations and create some perspective around that for the world to see. I think that's insightful and can create education and kind of level up category. So I've known Frank for a long time, I think over a decade now, more than my wife. That says a lot.
It's been a long time.
It's been a long time. And I feel like I've known Frank and Nigel even prior to that, because in my 2000s, shortly after school, Capital One was one of the first stocks that I ever bought, and began my romance with banking and credit and lending. So Frank is, I believe, one of the modern era's great investors, one of the great venture investors. Of course, he's on the Midas list. If I had a fintech venture list, Frank would be in the tier one bucket. He's fantastic. QED was formed by Nigel Morris, the former co-founder of Capital One, which is publicly traded, and Frank, who is also an operator at Capital One. And I have a personal interest in operators turned investors and business builders. I think they have just a very unique perspective that's not just top down, but also bottoms up. And Frank is also a first principles thinker. I've said before that I think Frank is doing physics for venture. He's got a great blog, great write-ups. One I might recommend is the 3-body problem. He has a great framework for explaining the storytelling process in venture, from seed stage to the next stage, and how you've got to underwrite that someone will buy the next chapter in the book. I'm just summarizing here because we're not going to talk about that today. That's out there in the public. We're going to go into kind of off territory in new area here today. And his handle on Twitter is Fintech Junkie. Frank and I are both framework junkies, so I always enjoy these conversations as well. And Frank also has a valuation discipline, which I appreciate as well. And obviously navigating the last few years post-COVID with that discipline has been really challenging. We'll see if we get to that. So some of the topics we're going to cover off on are, Frank's personal journey, from Capital One to here. Frank was almost fired once or twice at Capital One. I said, Frank, is it okay if I say that and ask you that question? He said, Ram, I'm an open book. Go ahead. I said, all right, we can learn from that. Clearly non-consensus since the early days. We'll talk about investment philosophy. We'll talk about the best relationship a VC can have with a founder. We'll talk about investment themes within the fintech subcategory. How do you approach quote unquote new buzzwords, whether that's 3D printing or AI or crypto or Web3 or whatever else it might be. And just other questions around the CIO process, right? Do you need unanimity when you make a decision? What's your CIO process, look like? What happens when there's a disagreement? And how do you allow for autonomy and freedom, but also creativity? And, so a lot of fun topics we'll get into. With that said, let's dive right in. So Frank, how were you almost fired at Capital One?
Let's jump right into the fun stuff. Yeah, so I was one of the early guard hires before it even was Capital One. It was Signet Bank. It was the 50th largest bank in the country, a regional bank. And, Rich and Nigel were hired away from their consulting gig at SPA to figure out how to crack the credit card business for Signet Bank. And I was one of the early people hired to help them do that. So over the first handful of years after the company went public, I took on a lot of responsibilities. And my responsibilities tended to be either building businesses from scratch that the company needed or fixing some of the big businesses when they were broken. I also played a horizontal role, which was the first chief credit officer of the company before there even was a title for the job. But giving that context, at the time when I almost got fired the first time, I was managing the subprime business at Capital One. It was actually my team that had cracked the code. We had taken it from a handful of people up to hundreds of people and thousands of people in the call center, a very large portfolio that we had built. And, I remember looking at all of the options for where additional growth was going to come from. And someone on my team came up with a really, really bold idea. And we have to date ourselves here. This goes back to 1997. So the internet was still a very new thing in 1997. It was not the thing that we see it as today, where it's a commonplace for people to go to find financial service products. But someone on my team was really studying the internet, and they said, we have two response channels. We have direct mail, right? So we would send direct mail to a customer. They could fill out an application and send it back. And we have phone. On the application, there's a phone number. They can call us and they can give us all of the information. And why not use the internet as a response vehicle? Why not figure out how to say, here's a website? And if you actually put a website up, you actually already know who the customer is. You know a lot of information about them because you've already pre-selected them or pre-approved them. You have their name, you have their address, you have all their credit information. So if you actually could just take an application over the internet, all you would need is an invitation code from the application that we would send them in the mail, and they would be done. They could actually click a button and just say, yes, I want the credit card, and accept it. And we thought this would be a really interesting experiment to see if we could get a lot more customers by reducing friction. So, the internet was a very new thing, and I tried to find the right people within Capital One to help us actually, execute this test. And at the time, Capital One created a horizontal team to go tackle the internet, which is what a lot of companies do. When something is new, a big incumbent will say, let's have a cross-functional team. Let's figure out how to assemble it. Let's let them prioritize what's important. Let's give them the keys to the kingdom of all the resources that are necessary to pull things off. So I went to this group and said, I want to conduct this experiment. And they said, well, you can get in line. It might be a year before you get this experiment conducted, because we've got lots of other things that we've already prioritized. Mm-hmm. Now, to me, this was not the right answer. The subprime business at the time was, I won't explain exactly how much, but a very important percentage of all of the company's earnings. And it was a business that I was running and trying to deliver more earnings for the company. And this was a test that I thought, as a P&L owner, I should be able to run. A horizontal group shouldn't be able to tell me what to do and what not to do, because ultimately the business lines were the P&L owners of the company and generating the revenue. And this was a huge revenue generation opportunity. So I decided to talk to someone on the team. And I said, do you want to help me build a website? And do you want to actually launch this test? And they said, I don't know how to build a website. And I said, I didn't ask you if you know how to build a website. I said, do you want to build a website? And they said, yeah, it'd be fun to do it. So I actually registered the getmycard.com domain using my own credit card. I coded up the back end of the website, and someone on my team ended up coding up the front end of the website. We actually launched the test without any corporate resources. And lo and behold, when you actually get the results back, you end up with a 20 to 25% response increase, which is massive, for business. And your marketing dollars just become incredibly efficient. So we're busy celebrating when we're getting the first couple of days of results back, from the direct mail campaign that we launched with websites attached to it that said, go to getmycard.com, to claim your card. And I get a call. And it's a friend of mine from the IT department who says, you're in trouble. And I said, what did I do? And he explains to me that the team found out that I launched a website without permission and that I was being called into the CIO's office. So I got called into the CIO's office, and he said, why did you do this? Why did you, do it yourself instead of going through the team? And I explained the why. Mm-hmm. I explained how important this was. And, I'll kind of skip to the conclusion here, but I got called into Nigel's office. I got called into Rich's office. I got called into the COO's office because what I wanted to do was the right thing. The way I did it was not the way that the machinery wanted to get it done. So even though we ended up getting a great result, it wasn't done the right way. And part of the problem was they had protocols for putting it on the right side of the firewall. They had protocols for doing a lot of things that we didn't do the way the company wanted it to. So I did almost get fired, for basically going around, the machinery of the company and knowing that I was going around the machinery of the company. Now, to put it in perspective, though, it created, massive increases to the P&L. That was the most important P&L to the company at the time. And there's a lot of lessons to learn here. Almost every time that I got fired at Capital One, it was about knowing what the right answer was for the company, encountering a no, and then figuring out how to get to a yes answer with the resources that I had. Then someone finding out about it, even though we got a good result, and then getting in trouble for it. So eventually, I had to leave Capital One. It took me, many, many years to figure out that my heart was in moving faster, more of a startup mentality, where getting the yes every single day was the important thing and not letting the machinery stop you. But I did spend, a good dozen plus years, at Capital One and figured out how to let the machinery not stop me.
And so you left Capital One then. That was born out of really a frustration with, I won't use the word bureaucracy, but I guess the fact you need all these approvals and other things, and you see the answer, you want to get stuff done. And then you rejoin Nigel later. Nigel is co-founder of Capital One. Of course, Richard there, you mean Richard Fairbanks, the co-founder and current CEO of Capital One, to start QED, which was one of the first fintech venture funds. There's a handful of fintech venture funds when QED was formed. Now there are way too many, not just fintech, but also crypto venture funds. But anyway, so how did you build trust with Nigel? So Nigel, incredible individual, leader, visionary, builder, and founders and operating executives are accustomed to making decisions because they quote unquote have the right answer, whether they do or they don't, right? So how did you build that trust and develop QED?
So as of August 9th, Nigel and I have spent 30 years together. So it's a long-standing relationship, and it dates me a bit. But Nigel and I built up trust over the years by being brutally honest with each other, but coming from a place of sincerity. I knew from day one that he cared about me and my career and the things that mattered to me and made me happy. Through my journey at Capital One, he was kind of my shield because I would make lots of mistakes. I was very young, took on a lot of responsibility very early, which is what happens at startups. If the board knew the responsibilities that I had and the experience I had, they would have told, the executives that they needed to replace me with someone with more experience. But, in a startup, you just do things for the first time and hopefully you do more right than you do wrong. And when I would do wrong, Nigel was there. He was there to make sure that I landed okay, that the people who are angry, he would kind of calm the villagers, with the torches that were very angry at me for different reasons. And then he would coach me and hopefully I wouldn't make the same mistake again. He built up trust with me because I knew he came from a sincere place. And I built up trust with him because I was one of the few people who felt like I reported to the truth and was willing to tell Nigel and to tell Rich as well that, the things that they thought might be the right answer might not be the right answer. And not a lot of people in a bigger company are willing to tell, the people in charge that the things they're working on or the things that they're setting as goals for the company might not be the right things. So we learned a way to interact with each other, to have the honest conversations, to debate things without, either party taking it personally. We tried to collapse everything to facts and frameworks so that we could, put decisions into a decision framework that we could kind of prosecute together. And then the most important thing is when we came to a conclusion, regardless of, which direction we were heading, we both owned it. So once I was listened to, or once he was listened to, if we made a different decision, we had to own that decision together and move forward with it. So I think that's where trust came over 30 years of just many, many debates, but knowing that we had each other's backs, and it wasn't just in the decision making, it was after the decision making.
Yeah, there are a couple of key principles there. One is candor, radical candor. Second is ownership. Third is disengage and commit, which is one of Jeff Bezos's leadership principles as well. You can disagree, go to the mat, have the debate, but then make a decision, support it in good faith, and move forward. But another one is having that executive sponsor, so you have the freedom and latitude to lead and bring your best ideas on the table, which unfortunately matters in a corporate setting. Speaking of radical candor, how do you engage with founders? What's the best relationship with a founder look like, especially when you've got to share bad news? And what's the kind of advice you'd want to give, but they perennially, ignore with the next crop of the batch?
Yeah, it's interesting because the strongest relationships that you build with founders start in the diligence process, where you're talking about their business. You're talking about what they want to build, and you're hopefully building a shared excitement and shared commitment for this vision that's going to take 7 to 10 years to really figure out. And if you think about a 7 to 10 year journey with any person, it's a really big commitment. So I was actually I would say disoriented during the peak of the super cycle, where you were meeting a company and term sheets were being issued in 4 days. Right? Like it didn't give me a chance to actually get to know the founder, and it didn't give the founder a chance to get to know me. But I find that spending a lot of time talking about the business, the thing that the person is most passionate about in life from a business perspective, and sometimes in life, like full stop, it's the thing that they care about most. You can build a very solid relationship by helping the person avoid pitfalls, helping them understand what they should be doing tomorrow, not just years down the road, but helping them figure out in a very tangible way that if you were in their shoes, what you would be working on to build the vision that they were excited about. Because talented founders, if you're additive and if you're taking away potential flaws in the business model, or you're increasing the odds of them succeeding, that's how you build a relationship, because again, you're doing it for the thing they're most passionate about in life. And, if you come from a place where it's not us versus them, it's not investors versus founders, it's about being in the game together. It buys you a lot of credibility over time so that you can have the tough conversations, because they know you're coming from the right place. So something that I always tell founders, and hopefully live up to it, is that, the challenging part is negotiating a term sheet, because you actually are on different sides of the table definitionally. But after that, once the term sheet is signed and the money is wired, we tuck it away. Like it goes in a drawer, and you hope you never pull it out again until there's a great, exit liquidity event or something happens down the road. But it's about, being the next employee of the company, right? Being someone who's actually doing work and helping. Someone that can be counted on for delivering against, important commitments of the company and advising for big decisions.
And how would you deliver bad news to a founder? Now, you talked about building trust with the founder, which gives you the permission to do so. But there's this other concept out there of being entrepreneurial friendly, right? So there are some funds like Founders Fund where it's like, hey, look, if you need advice, don't come to us. We're trying to find the best founder. That's one school of thought. And the other is, hey, come to us because we have a platform, we have capability, we have expertise, we have playbooks, we can help you get that VP of sales. Here's the playbook. So there's a spectrum of approaches around that.
Yeah, I think the concept of being founder friendly is just nonsense. Complete and utter nonsense, right? Because if you ask a founder what being founder friendly means, they're going to say, give me as much money as I ask for, whenever I ask for it, at the highest valuation, and let me make decisions when I want to make decisions, and let me come to you when I want to talk to you, and then just get out of my way the rest of the time. Right? Like it's nonsense. Being founder friendly should be sometimes telling them the things that they might not want to hear, or telling them something in a way that they're willing to listen when other people might not be able to explain it to them, in a way where they're capable of actually ingesting it and figuring out what they need to do. The important thing is becoming a consigliere, to the founder, telling them the things that they need to hear, right? Because otherwise, if you ask the founders what they want, you might actually be doing more harm than good. There are times where the right answer for a founder is to realize that the thing that they had a passion around, the idea that they have, might be harder to build than they thought, and it might be smaller than they thought. And when you come to that conclusion, the answer might be, let's actually figure out how to turn this into a profitable machine. Let's get it into new hands, maybe under a different company, that might be able to take it to the next level, and then free you up to go do the next thing, which might be bigger. It might be more exciting for you. Mm-hmm. Mm-hmm. And for a lot of founders, like, that's really hard for them to stomach. And if we're up to them, they would keep pounding, the wall, trying to make it bigger than it might be, trying to infuse more capital to try to almost big bang their way into something that's bigger. So a lot of times you end up as a coach. Sometimes you're a mentor. Sometimes you're, a psychologist. And sometimes you're actually an employee and someone doing work for the company. But you have to be all of these things in order to become truly the consigliere to the founder.
Right. What's your take on personality typing? I'll give you some context here. So Mark Andreessen had a podcast with Andrew Huberman the other day, and Mark was sharing that his framework is the Big Five personality test. So he finds or identifies founders based on over-indexation on openness, under-indexation on neuroticism, and he goes through all the other levers. I certainly have my own framework too. I think we all have a framework, and I'm curious to hear, what do you look for to underwrite in personality, or you look as like a reject decision rule?
Yeah, I think from a context standpoint, QED, the product that we offer to founders is that we are active investors. We aren't just money. We are, almost all of us are ex-operators of some sort. We get very involved in the business. And if we're not going to get involved in the business, it's probably not an investment for us, right? So the context is very important, because there are certain funds that want founders that don't need any help because they might not be able to provide it for them. Mm-hmm. But for us, we're looking for a partnership where the sum total of expertise, at QED is valuable to the founder. They see it as valuable. At the same time, they're competent enough that we're not doing all of the work, because then it's a disaster. Like, if the founder doesn't have the core capabilities, competencies to build the business, then there are going to be some barriers that they might not ever be able to get over. But from a founder personality standpoint, there are a couple tests that I have. The main one, I always call it the phone test, which is, imagine that you're sitting at your desk working through email, which can be pretty boring at times, but you've got to do it every single day. And you're sitting there working through your backlog, and the phone rings, and you see that it's that founder on the other line. Are you willing to interrupt your email in order to pick up the phone? And are you excited about getting rid of this boring thing called email because you really want to talk to the founder? Now, if the answer is no, and email is more exciting than the founder, that's a problem. Like, that's a big problem if email is more exciting than talking to a founder. Or if you find yourself saying, man, this is going to be a difficult conversation, maybe I'll call him back in a few minutes when I'm ready. That's a problem, right? You want to be working with founders for whom you're excited to have a conversation, whether it's good news or bad news, whether it's about a decision they're making and you're trying to, help them think through a critical decision, or it's about a new hire, or it's about a request. Like, you want to be excited about picking up that phone. And I think that it cuts through so much of the noise, because there are personality types where, you could call it the arrogant founder. You could call it, the founder who believes they don't need help from anyone, the founder who only calls, when they need something from you, but they never share good news with you. Like, there are all these personality types. And what you want is to be the first call when there's good news, the first call when there's bad news, the first call when there's a big decision to make. And I think we find ourselves in that position, pretty frequently because of the way that we operate.
Makes sense. And I liked your earlier point as well around like the average duration of a venture investment at 7 to 10 years, which is longer than the average duration of a marriage. So make sure you have a good relationship that you're looking forward to. In consulting, there was a similar kind of test. It was called the airplane test. If your airplane is delayed for 3 hours, are you going to look forward to hanging out, with this person on your team? Are there, I have a pet thesis that there is clustering of personality attributes around great founders. It's not a one-for-one by any stretch. But, in Myers-Briggs, for example, I think it would be an over-index on the N and T attributes, for example. Intensity. You mentioned, I used the word obsession. I think you used a different word to reflect the same concept, meaning this is their life's passion or focus. Obviously, smarts and intelligence and work ethic. But, are there other attributes that you look for, less on the rejection side, but you're maybe pattern matching and saying, okay, here's a cluster of attributes that I'm seeing here that indicate that this may be a good founder?
Yeah. Well, I mean, there definitely is a founder market fit test. What you find, especially in highly regulated industries, is that if you took a talented MBA and you had them analyze the industry as an outsider looking in, they would actually get it wrong, right? Not by a little, they would get it wrong by a lot.
Oh yeah.
Right. So in fintech in general, and certain subsectors of fintech specifically, like lending, like if you actually asked someone without any lending experience to figure out how to make a lending business work, they would get it completely wrong.
Totally. Absolutely.
And there are founders who I've talked to that come from, they're ex-Googlers as an example. And they're like, we're just going to build these data analytics models and it's going to give us more signal on the risk and blah, blah, blah. Our models are going to be better than everyone else's models. And I'm like, have you ever heard of Reg B? Have you ever heard of, the inability to actually underwrite on certain variables, even if you didn't put them directly into the model, if they're correlated with protected class? And, understanding who makes what decisions. Right. So if you're selling into a bank, like, do you know how the decision makers within the bank actually figure out how to purchase products? Do you understand the procurement process within a bank? Right. So there are a lot of things that, either the founder or the founding team, sometimes it's a collective that has the experience that's necessary. Like, you have to underwrite to that in highly regulated industries. And then there's an openness issue. Right. So are they willing to listen to experts that might have been through the drill, multiple times when they're going through the drill for the first or second time? How do they absorb that information? And the most important part of it is not saying just listen to us verbatim. It's about being able to digest information coming from advisors that have experience. Mm-hmm. Right. And knowing when the information is relevant and when it isn't. Mm-hmm. So there really is this openness that I find that's really important. There's also an appreciation for the fact that you are in a highly regulated industry and you can't just break things and ask for forgiveness later. There's a personality type that says it's me against the world. I'm trying to innovate. The world doesn't understand what we're trying to do. That's the easiest way to blow up your business, because you're going to end up pissing off a regulator or a debt provider or someone at the bank that you're trying to sell your product to. Like, you have to understand that you're ultimately in an ecosystem that operates in a particular way. And as much as you want to blow it up, you just can't say, I'm different, accept me for who I am. It just doesn't work that way.
Right. That's especially true for fintech, where there's a lot of compliance and CFPB and securities laws and truth in lending and Reg B, and then, a whole host of other regulations. And I agree with your founder market fit approach. let me challenge this. I'd love to get your perspective on it. You have other leaders like, say, Elon Musk, right? He's got a space business, he's got a car business, he's got a solar business. He started in PayPal. He learned payments from scratch, and he's more of a mercurial kind of personality. Probably, I haven't met him. I imagine he's probably not as open to feedback. Probably makes a decision quickly. Brilliant person. Probably gets most of the decisions right, or if not, he pivots quickly. Or Chris Larson, the founder of Prosper, etc. So there, the other side of it is maybe it's not about founder fit. It's about founder tenacity, ability to learn quickly. Or like Travis, founder of Uber, for example, and he ran afoul of all sorts of regulation. Look, being the taxi and limousine commission regulation is not the same thing as breaking financial regulations in terms of the penalties and the repercussions. So just curious how you think about that. And maybe the answer is, look, I use founder market fit as an underwriting principle to maintain discipline while recognizing that there are other founders that would fail that filter, but they'll still be successful.
Yeah. I mean, there are founders that in highly regulated industries are looking for a fight. And, they could win. Like, it is possible that you could challenge the SEC and win. It is possible that you could challenge the Fed, and win. Like, there are ways of winning these battles, but it's a pretty big risk factor, right? So the prize that you're fighting for better be worth it. If you're going to go to the mat and try to fight against the powers that be, because ultimately they really are the judge, jury, and executioner. And the chances of winning are actually slim if they decide that they don't want something to happen.
Absolutely.
So it's not that, these personality types can't win in a highly regulated world. It's just understanding and having an appreciation for where you sit in the ecosystem and who gets to make what decisions and when is critically important. And understanding that if you run afoul of the wrong people, you can get shut down, right? And if you get shut down, it's not like you can appeal and just say, I think you're wrong.
Right.
Like, you literally get shut down.
Right. You have no license. You're not permitted to conduct business. Can't get around that.
Yeah. And a lot of these founders that are attacking highly regulated industries, they figure out how to grow big enough, fast enough that they could fight the fight.
Right.
Right. And in fintech, sometimes that's pretty hard to do.
Right. These generalist founders, like the founder of MongoDB and DoubleClick, and he's done dozens and dozens of things. Although those are not highly regulated industries, I think is the key distinction here. So the cost of getting it wrong is much lower. So why don't we shift gears and talk about your CIO process? How does it work? And what happens when there's not consensus? You've got a partner who says, look, I'm excited about this deal. I want to do this deal. And, someone else on the table doesn't agree. And, how does that vary? You're the CIO, so you're going to have the biggest thumb in the room. But do you require consensus in the group?
So first, as the CIO, I don't have the biggest thumb in the room. I am one person in a process, that we've outlined that we think works for us. Now, I'm going to be a little bit an overgeneralization here, make an overgeneralization. And in fact, I don't mean to offend anyone with this generalization. But if you actually think about the venture industry, there are two main types of models that I think a venture firm can adhere to. One, I affectionately call the genius model. And the genius model basically says you hire someone who is ridiculously insightful, borderline genius level, and you figure out how to round up a bunch of deal flow, top of funnel every single year. And what they do is they just meet with founders and look at the businesses, and then they point and they say, this is the one. And you ask why, and they say, because I'm a genius. I've seen lots of things. This is the one. This is the one that has, the right return profile, risk profile. Like, it just is the one. This is the founder with special sauce and a model that's going to succeed. And, you basically assemble a bunch of geniuses together within the firm, and they each have their funnel, and they figure out what they like to do. And by and large, they stay out of each other's way because they create swim lanes for the things that they want to look at. And they say, no, I'm the genius for thing X and you're the genius for thing Y. Like, you go do your thing, we'll go do our thing. And then we'll come together when we need to raise capital, right? So it's a shared capital base, but independent.
Right. Each partner has their own swim lane or show. Yeah.
That's right. And by the way, this can work, and it can work incredibly well if you hire the right people. But the ability to scale is contingent on you finding geniuses that can continue to deliver, right? And by the way, a lot of people think venture isn't scalable because they ascribe to this model. And they say, you can only figure out how to put so many people together in a model like that and have it work. The other model, you could treat investing as a profession. And you can say, look, you still need ridiculously talented people. This is not a job where an average, person can really do it well. But you need very, very talented people, but it's skill. And it's something that can be fine-tuned. And to fine-tune it, you need a process that's repeatable. You need a feedback loop. You need repeatability in a lot of ways. And for us, we've tried to design a process and hire the right people where we think the process itself creates the outputs that you need in order to manufacture returns. And, there are a lot of similarities between the two models because it all starts with really talented people and generating deal flow and evaluating it. And eventually you point and say, this is like a business that I'm really excited about. Yeah. But for us, no individual investor underwrites alone. When they get interested in something, a small team forms. And that team is meant to protect against proximity bias, as well as make sure that all corners of the investment opportunity are examined. Because one of the most difficult things to do as an investor, and you need to have this skill to be a talented investor, and it's why a lot of operators, by the way, cannot make the transition to becoming a good investor, is that you have to hold two things true at the same time. One, that there's tons of risks in the business and the chances are it isn't going to work. And identifying those risks typically is pretty easy. Figuring out in advance why something will fail, super simple for intelligent people. You can point out why something will not work. And in fact, you can come up with a dozen reasons why a startup won't work. But simultaneously, you have to hold true that if everything goes right, how big of a business could you build? Right? Because you only get paid if you say yes and make an investment and the risks don't materialize and a big business is built on the other side. So by having multiple people in the process, it's about challenging and saying, look, here are the risks. We know what the risks are. Are these risks that we're willing to take on because we believe the upside offsets it so that you have a good risk return trade-off for the risks you're taking on. Now, if every deal were priced at 3 million pre or 5 million pre, and with one check, you could figure out if a company were on a trajectory to a mega multi-billion-dollar IPO, then you don't have to worry about the risks. All you have to do is worry about the upside, right? But when you're de-risking a business in stages, you need a process which really outlines what you're going to learn, how quickly you're going to learn it, how much money it's going to cost you to learn it, and then what happens next if they de-risk a business that looks good. So, you're really playing a multi-turn game. It's not a single turn game. And a good underwrite says, this is what we're going to de-risk with this capital, which leads us to this position in the company. And then we're going to do these things next. And it's going to require this much capital to learn this about the business. And even though you're wrong in advance, the logic of going through this paints a picture of what it would take to build a very successful business in that space. It gives you an idea of how much capital it might need. It gives you an idea of how quickly you can learn and how efficient you are for every dollar you put into a company to learn. And it gives you kind of a narrative to talk to the founder about, right? So a lot of VCs don't like underwriting the business plan. And in our underwrite, we underwrite the financial forecast and business plan, pretty deeply, because the financial plan is an articulation of how the founder sees the future playing out, just expressed in numbers. And there's so many interesting embedded assumptions in there that you can use to talk to the founder about why they think their business is going to unfold the way that they think it's going to unfold. And it's that conversation with a small team of people and the founder that exposes how the founder thinks, why they believe the things they believe. It gives us a chance to maybe insert some new information and maybe tweak the plan, right? Maybe make it better, maybe make it more capital efficient, maybe knock down, the number of things they're working on and give them a better chance of focusing on the things that need to be de-risked. But it's that entire underwriting process with a small team that comes together, that ultimately helps prosecute both the risks plus understanding the upside of the business if things go right.
Mm-hmm. Right. I like the discovery hypothesis-based approach too, where you've got different milestones. You're saying, okay, look, here's the current traction to date. What's the incremental spend or investment capital we're going to make to learn something new? And I think you have a poker analogy around that, which I love too. I think decision-making uncertainty is a very good framework to think about investing in startups. If you're dealt pocket spades, you're going to invest to understand, the flop. Whereas if you've got a mixed pair, you might calibrate differently in terms of your investment appetite or valuation.
Yeah, I mean, the question that I constantly challenge the team about to get an answer to is how much can you learn for how much money, how quickly? Right? Like that's exactly all you really care about, because this financial model that's produced by the founder describes a magical business on the other side. Right? There's no reason for them to put it together if there isn't an outcome that looks just amazing.
Right. Of course. They all look great. It's always up and to the right. Yeah. Never seen one that wasn't.
Everything looks great, high margins. You've got a big market to, attack. You build this giant business. It's a profit machine, right? So you've got this magical spreadsheet. And then as you dig in, you say, wait a minute, how much is it going to cost me to learn whether we're right or wrong about this critical driver of the business? And understanding whether you're going to de-risk it with this money that would come into this round or money in the next round, is really, really important. So a lot of the work that we do with founders, during our underwrite is to create discipline around the learning agenda.
Absolutely. That's exactly the right approach to take. I mean, you're going into the dark forest. You have an intuition, there's light on the other side, there's a prize, there's a pot of gold, but you're dealing with uncertainty, and you've got to prioritize and do fewer experiments more quickly, cost efficiently. And so, no, I appreciate that. Let's double back to the CIO process. How often does your CIO committee meet? What's the number of people that are on there? What's the composition of roles and responsibilities? I imagine it's a CIO, yourself, and then partners and junior partners. And then what's that decision-making process look like? Is there caucusing? I imagine there's maybe a memo, there's a discussion of the memo, and then do people do a quick thumbs up, thumbs down? And what's the decision rule around that?
So pre-pandemic, we used to have a very disciplined, outline, structured process. And what we learned during the pandemic is that there's a lot of work you can do in an asynchronous fashion where you don't necessarily need to be, calling the founder or founding team in to meet with everyone face-to-face in one big bang, investment committee meeting so that you give a thumbs up or thumbs down. So we've learned to actually do the work as the work is needed to be done, which is very different than just a gauntlet and a process that you kind of march through and you hit milestones and check them off. Mm-hmm. So, the process actually starts with originating deal flow, right? So every single partner on the team, every single investment professional, so the principals and everyone on the team, ways of originating deal flow. And everyone does it differently, which is incredibly additive, because a typical, investment professional on the team will figure out how to source between, call it 3 and 400, 3 and 500 new businesses a year. So we have 20 some odd investment professionals, and that tells you how many deals that, we tend to look at over the course of a year. Mm-hmm. So step one is actually triage. figuring out with all the deal flow coming in, how to get the company to the right person on the investment team so that the first call is most meaningful. Mm-hmm. So, you can hear horror stories from founders where, they spend the entire first call with a VC explaining to them the space that they're in, explaining to them the problem that they're trying to solve, and trying to educate them on why it's an interesting problem. We try to show our competency all the way from the first call. And the way to do that is to get it in the hands of the right person. So we have people with different operating backgrounds. Someone might be a payments expert. Someone might be a lending expert. Someone might understand wealth management. Someone might be focused on Africa. Someone else on India. So we try from a triage standpoint to make sure that the founder gets to the right person for the right first call. Mm-hmm. That person, the investment professional, takes a first call with the founder. If they get excited about it, they will take a second call with the founder. If at that point they're still excited about it, a small team spins up around the opportunity. So if it's a payments deal in Africa, we have a partner who focuses on Africa, and then we have an expert on the domestic team who knows payments. They would probably team up with, probably a principal, and that would become, the team to really dig into the opportunity. And at that point, mm-hmm. we're spending a lot of time, in talking to the founder, talking to the other people on the team. We don't restrict it just to the founder. We're trying to get to understand the company and understand, what I think of as the 5 major statements that are being made by, founders, when they're, putting a plan in front of you. There's the problem statement. There's the solution statement, right? There's the go-to-market motion statement. There's the founder market fit statement. And then there's the financial model, right? The mm-hmm. financial statement about what the prize is worth, if you end up building a business. So we try to dig into all of these statements to figure out, is the problem a real problem? Is the solution better enough than the solutions that are in the market that you could build a business around it, mm-hmm. right? Figuring out with a go-to-market motion, if there's a way to efficiently, generate a large number of customers without just consuming massive amounts of capital. Mm-hmm. The founder market fit, we've talked about that, and it's really the founding team and really digging in about the competency that surrounds the opportunity, and then the financial statement. So the team starts digging in. If they get interested in it, they'll get myself involved, and then we have a few other people. Bill Salufo manages our early stage fund. Chucky Reddy manages our growth fund. And then there's Nigel, who's with me, a co-founder of the fund. So all of us will get involved at some point. Some of us might be meeting with the founder to get our own questions answered. We might be meeting with the internal team, to figure out what they've learned and why they're excited about it. But ultimately, we're all going to end up spending time on the company, and then we'll sit down and have a meeting, right? We will have a conversation about the company and decide whether it is a good risk return trade-off to say yes, and under what conditions. So, it's really up to the small team that's come together, right, to present the case that, this is a great opportunity. And part of my job is to make sure that it fits from a portfolio construction standpoint, that we understand the risks we've taken on, that we understand the upside potential of the business as well. And that from a holistic standpoint, it's a good decision to make to add it to the mix. Right. But we're all involved in.
It's very interesting. Right. So in contrast to like a deal driven linear CIO process, here's the committee, are we going to assess this or not? It's more organic. It's concentric driven. It's actually partner founder market fit. And that partner team combination attaches the expertise that's relevant to the deal. You win that local confidence and then broaden out to other stakeholders. Is that a fair summary?
It is. And in doing that, the different people on the team can probe on different dimensions. So Nigel, as an example, is by far the best person on our team. His superpower is getting to understand founders, what drives them, what skills they have. Are they open and receptive to help from QED? Do they have the ability to manage the teams and scale? Where are there gaps from a competency standpoint? Like from a people standpoint, his superpower is just being able to almost have x-ray vision and see things about the founder or the people he's met that they might not know about themselves, right? My superpower is really collapsing things to first principles and being able to build up, a case from the ground up that's consistent with, if everything goes well, like an amazing and understanding the risks such that we know how we're going to de-risk the business stage by stage, right? So we each have different superpowers and we try to apply them during the process.
Right. Now, what if one of the partners along that journey says, nah, I don't like it, but you're excited about it, or maybe Nigel's excited about it and you're not, and you feel like you've gotten, what happens? Do you say, hey, take a gamble with me, let's do this, it's a smaller deal size, the cost of learning is low, it's not a big growth investment? Or do you say, no, we need unanimity and we're going to walk away?
So we do need everyone to say yes in order for us to move forward. Now, there are times that someone is neutral on an opportunity and, in a neutral stance where they say, look, I can see the pros, I can see the cons. I might not do this one, I might do this one, but if you're passionate about it, like, let's talk about why you're passionate about it and, probe deeply on the person who is going to be spending the most time with the company about why. And a lot of times constraints are the best way for surfacing how excited someone is about something. So a typical investor at QED makes somewhere between 1 and 2 investment decisions a year, right? So they invest in 1 or 2 companies a year. So when it's that rare, you can say to them, are you willing to use up one of your bullets this year? Like, is this the company that you want to invest in? Because over the course of the next 4 or 5 years, you're only going to get 10 companies. And, is this one of those 10 companies that you want to spend the next 7 to 10 years with? And let's talk about why. But if there is a hard no on the team, then it's a hard no.
Right.
And we will keep the conversation open where, ultimately, if the person says, look, I want to have another conversation and do the work to try to convince you. The key is anyone who is saying no needs to explain why they say no. And then if the other person who wants to say yes can do the work to convince them about the things that they're saying no to, then hopefully they can overturn that decision. But, we believe that, it's about being able to explain your perspective. And then hopefully if someone has issues with it, putting frameworks together, analysis together, and having the conversation. So you either convince them or they convince you.
And just real quick on the funnel statistics, and you touched on that briefly before. So if a partner on average gets, say, 2 deals plus or minus 1 funded per year, at the top of the funnel, how many are they looking at? And how many deals do teams form around opportunities? And then what percentage of that gets to funded?
Yeah, I mean, we have a massive funnel. I mean, our surface area is now global. So you can imagine like how much deal flow comes in. I mean, when we lit up Africa for the first time, we hired Benga as a partner in Africa. In the first 6 months, they had 500 deals come across their desk. So like, there's a lot of deal flow out there. So a typical funnel might look at 300 to 500 new deals in a year. Some of them are just clear no's. They just don't fit with what we're interested in, or they might conflict with something in our portfolio. We just don't spend time on them. If I just think of my history over the past 15 years of investing, I would say there's probably somewhere between 6 and 10 investment opportunities a year that I would dig into. And of those 6 to 10, I would get conviction around 2.
Got it.
So you do a lot of work sometimes to just say, I really like you. I like the company. I like where you're heading. But, here are the risk factors. And, here's why I think this isn't a good investment for us. And what I'll say is, if you ask me about any of those 10 companies a year for the past 15 years, with just a few minutes refreshing myself on, let's say, the last deck that I saw, I could tell you precisely why I said yes or no. And this is
Right.
important because if you believe this is a profession and you need a feedback loop, you need to be able to articulate why you're saying yes and why you're saying no, letting the future play out, and then seeing if you were right or wrong.
Absolutely. That the reject inference, which of course you learn in lending, right? You look at all the deals that you passed on and what subsequently happened. Do you find a correspondence between your conviction at time of underwrite and subsequent performance?
No.
I agree, by
So,
the way. It's really funny. Isn't that the case? That you're very excited about A, and it turns out B is the winner.
well, it's funny because my wife has had to deal with this over the years, but I mean, I'll get super excited about an opportunity, and I start losing sleep when I'm getting ready to say
Right.
yes to a founder. Like I'm just thinking about how I would operate the business, and I get conviction when, I know what I would do tomorrow if I were running the business. Like that's the level
Interesting.
of conviction that I
Yeah,
get.
absolutely.
And she has to listen to me talk about it, and that's a job of a good spouse, right? To be there
Right.
and listen.
Internal processing.
And then 3 years later, 4 years later, we're writing off the company, and she says, "I thought you were so excited about that." And it's like, I'm excited about everything by the time I get to yes, right? There aren't marginal decisions, right? If you're only making one or two a year, like these are all companies that you're excited about. And it makes it that much more painful when they come crashing down because, the reality is, if you look at our history, about 25 to 30% of the businesses end up being complete write-offs. You end up with about 40 or 50% of your distribution being okay, 1 to 3x return companies. These are not hugely successful companies. These are small M&A opportunities that are picked up by a strategic. And then it's 25% of the companies that do really well. And of those 25%, it's half of them that are off the charts. So if you think about the investing pace, let's just say it's 1 in 8 ends up being that up into the right company that's really what you're underwriting and believe in. It's one every 4 years. Right? Like it's an amazingly difficult profession to get so passionate about everything and then really be only like very right.
I totally agree. Venture is so different from private equity in that regard. In private equity, the base case expectation is that you're going to make money in the vast majority of your deals because you're hitting singles and doubles. Whereas in venture, you do need extraordinary outlier performance from a handful of deals. Do you find that the mental model or rule of thumb that's out there that you need 1 to 2 fund returners to make the economics work, is that your experience in general?
So it helps if you can do that, but it's not the only way to make money.
So you don't have to get the grand slams. You can actually have a weighted average return with outcomes that don't necessarily include grand slams, but you're getting a high quality expected return anyway.
Yeah, I think the key is there are many ways to make money in venture, but you have to choose one and do it well. You can't have a grand slam or strikeout philosophy for half of your deals, right? Like either it's your philosophy and you're going to be underwriting to a mega IPO or the thing could fail.
Yeah.
And you have to get in at a price where it's a fund returner or it isn't, or you create a decision process that actually understands how to underwrite intermediate outcomes, which by the way makes you more price sensitive.
Absolutely.
Right?
Yep.
And that's why some VCs, they say price doesn't matter, because if it's a grand slam or a zero, does it really matter your entry price? Now, I believe it does.
I agree.
I'm just playing out kind of the
That's
philosophy.
the consensus view, I would say, though, right? And I'll generalize West Coast venture. I have plenty of West Coast venture friends too, but the thesis is, hey, look, if I get 1 to 2 fund returners, price doesn't matter because I'm looking for a 10x or multi-unicorn reward that's going to compensate for the losers, and that's based on the insight that venture outcomes do follow a power law distribution. But your approach is non-consensus in that you're looking for performance in the belly of the distribution.
Yeah, I mean, I actually believe that great companies are built on top of good companies, right? A very different philosophy than some VCs, and it comes from my operating background. It's not like, to build a $20 billion portfolio that's minting money, like it happens overnight. No, you figure out new things every year, and you have to constantly build a better business than you did the year before. And I think it's the same with these venture businesses, these startups where you have a lot to de-risk. But if every year the business is better than it was the year before, right, eventually you move out of the world of having no intrinsic value into a world where you have intrinsic value. And once you have intrinsic value on the opportunity, then you can look around and say, what opportunities do I have to generate additional enterprise value? Is it a team that could become a multi-product team? Some teams, the answer is yes, and some teams, the answer is no. And you don't always know it in advance. There are some markets where when you get to a certain point, you have more opportunities in front of you, and there are others where the opportunity set is collapsing. So, the thing that I obsess about is this metric, which is enterprise value to paid-in capital. And I'm not talking like phantom valuations created by the venture community to insert capital. I'm talking about the actual value of the company if you were to sell. Right? So in order to get a venture type return, you really need to be generating about 10 times enterprise value to total paid-in capital in aggregate. And at a destination, usually the founders or the founding team, the employees will end up with, call it 30% ownership in the company, 20 to 30%. So it means that capital as a bucket ends up getting about a 7x return if you have a 10x enterprise value to paid-in capital. That 7x return means that the last investor coming in probably gets about half of that average, maybe a little bit less than half that average. So call it a 3x return. And it means that the early investors end up getting double, triple, quadruple that return, depending on how early they were. So they end up getting the true venture returns of 15x, 20x, 30x returns. So capital efficiency is what's actually important in generating venture returns. And if you can find capital efficient models that can generate enterprise value, then you can invest with the middle of the distribution in mind. In fact, a lot of our outcomes were single-digit billion IPOs, not the decacorns, not the generational company that comes along once every decade like a Facebook. We have Remitly, we have Flywire, we have Avid Exchange. Like these are good companies that make money.
Right, Credit Karma, etc.
Yeah. Credit Karma was one of our bigger outcomes. Nubank was one of our bigger outcomes. But with SoFi was another one of our recently taken public companies. So you can actually do quite well if you end up with a $3 billion outcome if they were able to do it with under $300 million worth of capital invested. And if you were an early investor, like you've done quite well in building that business.
I agree. It's incredible that first off, you've got that many IPOs. Many venture firms never get an IPO, and those are considered still first-class venture firms. That's one. Two is, the idea of unicorns is a modern, relatively recent phenomena, and the ubiquity of unicorns. I'm sure you've looked at the public markets data showing how valuations have collapsed, but the number of unicorns in fintech has not, due to LPs not marking down and the incentives around that.
I mean, I've studied this pretty extensively, and if you actually look at the history of investing in venture, it has its ups and its downs, but in general, somewhere between 2 and 3% of companies in a bull market will go from seed all the way to an IPO. In really good markets, frothy markets, some companies go public that shouldn't go public, and you end up with a slightly higher number. And in some bear markets, like the number could be a little bit lower and M&A activity picks up. There are some vintages where only 1% of them end up going public, but it's 2 to 3%. And the biggest mistake that you can make as a venture investor is to underwrite every company as if they have the ability to become IPOable.
Well, that's SoftBank and Tiger Global, I think, but that's my view there.
Yeah, I mean, they're playing venture capital with an extra zero, both on the check size and the outcome they're looking for, right? Like that's a completely different game. But the biggest mistake that I've seen from compatriots that I have is they underwrite an opportunity at the seed stage, and they're like, well, if they succeed, a multi-billion-dollar company, therefore I don't care about valuation. And I'm like, give me the narrative on why this has the making of a public company. And a lot of them will say, well, we don't know. It's a talented founder and there's big TAM. I'm like, that doesn't talk
and
about
the TAMs are so BS, especially in fintech. All of payments is the TAM. Come on.
But you can look at market structure. You can look at economic rent capture. You can look at, the competitive set. Like there are things you actually can do. I am not, and in fact, QED is not team and TAM investors. We actually do the work to understand things at a much deeper level, even though you're wrong. That's the thing a lot of venture investors can't understand. Why would you do the work if you know you're wrong? You do the work because it helps create kind of the canvas that you're playing in.
Yeah.
And if you understand that, you're going to find opportunities where you say, the odds of this ever turning into a company that, brings in hundreds of millions of dollars of high margin revenue or billions of dollars of low margin revenue, zero. Right. And there are opportunities that are coming across your desk where the answer is zero. So either it's incredibly capital efficient and doesn't need a lot of money to create something that is IPOable, or you shouldn't invest.
Right. No, it's interesting. And that, I was about to ask you this question around like the type 1 or type 2 error that you prefer. I think you've already in a way answered it, right? So if you're shooting for the moon, then it's very expensive to miss the deal that got away that produced a big outcome because you really needed that. And there are not that many of those. On the other hand, that's called of course, a false negative, right? On the other hand, if you're taking, your approach where you can harvest returns in the middle of the distribution, or you're sensitive to the enterprise value, again, based on what an acquirer would pay versus paid in capital, then you've got more freedom and you don't have to worry about the deals that got away. You got to focus on avoiding false positives.
Yeah. And it actually helps us play a role in managing, helping to manage the company. We don't manage them directly. We're not control investors, but, I should say advising the company, not managing the company. Mm-hmm. But, in the advice that we give to companies, it's about making sure that every dollar that's being invested, right, is serving a purpose, hopefully in generating some form of enterprise value. So I think of founders as asset allocators. Right?
Absolutely.
At their core, they're allocating money and they're allocating people.
That's right.
And they allocate them to one of three things. They're either building product, they're either testing product, or they're scaling product. And guess what? Only the third one generates enterprise value. So, your learning agenda about, shipping magical code, who cares? It's a very important part of the journey, but you're not generating enterprise value. So you want to do it for the least amount of money as quickly as you can because you're burning cash every day.
Well, you want to get to market quickly and generate revenue quickly, right?
Right. And then testing product, right? Like, what are you actually trying to learn when you put this product out into the market? And this is where discipline actually disappears. Because pulling up and saying, what have I learned? You're either getting proof that the assumptions that you have in your business are correct, or you're getting anti-proof that's telling you that the assumptions that you have are wrong. So, one of the biggest problems that I have with the VC ecosystem, especially at peak super cycle when things were crazy, is that there was an assumption that if a business doubled its revenue, it was worth twice as much. But there were companies that in order to get that doubling, they were burning massive amounts of cash. It was harder to do than they thought. It was actually NPV negative to actually generate those customers. They were basically giving away dollars. They were selling dollars for 75 cents, right? But people would look at the top line metric and say, wow, you grew 2x in 9 months. We should double your valuation and give you more money. But some of these companies developed anti-proof. that it was really hard to actually efficiently scale the company. They scaled through brute force. They scaled by giving away something with negative economic rent capture, right? So the discipline actually matters, in actually scaling these businesses. So when we advise companies, we have to be able to look at all of these things, and getting to know the company at a very deep level is the first start.
Absolutely. As it relates to go to market, what's your thoughts on social media? I know you're an investor in Current, and I've spent time with Stuart and Trevor, the co-founders, and they had a social media deal with Mr. Beast, and I was introduced to that at I think your QED summit a few years ago, and that opened my eyes to social media. Of course, you look at what Elon Musk is doing and pays zero on ads, at least today, and is engaging directly with his audience. What are your thoughts on kind of current go-to-market tactics that are effective in social media specifically?
Well, I think, again, to collapse things into a framework, there really are two types of businesses. Businesses where the go-to-market motion gets easier as you get bigger, and ones where they get more difficult as you get bigger. And it's a generality, but a lot of consumer businesses, they get more difficult as you get bigger. And a lot of B2B businesses get easier as you get bigger, at least for a certain, growth.
Direct mail response rates decline the bigger you are.
Right. But for a lot of B2B businesses, like logo collecting, building up social proof, actually building out the functionality on the product over time as you learn what your customers need. Like a lot of times B2B businesses, the go-to-market motion gets easier as you get bigger. And a lot of consumer businesses, they get more difficult as you get bigger. What social media has done for both of these businesses is give a new outlet for at least testing whether there's any virality in the product, whether consumers will like your product enough to be able to share it where all of the people are, all of your prospective customers are, and be able to talk about it in such a favorable way that you end up originating another customer without having to do any work. So, you can look at some of the amazing growth stories of the last super cycle in fintech, and some of them had near viral growth paths, right? You can look at Robinhood. You can look at Coinbase, as examples of consumer businesses that just took off because everyone told everyone else about them. And guess where they were telling them about it? Social media, right? We had one, Nubank. Nubank is a good example. It's a public company at this point, doing quite well, still originating millions of customers every quarter. But for the first 6 million customers that it originated, I think it was about 100,000 of them were originated using paid marketing, and then they turned it off because the virality took over, and they were able to scale through social media and word of mouth. So if you really want to build a mega large business, you need some level of virality, and the virality definitionally goes with social media, right? Like that's where the virality ends up showing up. We're actually seeing this even in some B2B businesses where they're using LinkedIn and they're using Twitter and they're using, other channels to really tell stories about themselves and give social proof that there are other customers buying their product. So I think it's a new vehicle because there are eyeballs, right? Where the buyers of your product are perusing like these sites a lot of their day. If you actually were to open people's phones and look at the time consumption on social media for the average person, I mean, it's hours and hours and hours every day. So if that's where they are, whether it's in a professional or a personal context, they might be seeing your product, and it's a whole new way to build awareness.
No, I agree. Yeah, the market for attention, one of the most valuable markets in the world. That's why Google is a valuable business, and others. Any thoughts on the outlook for venture overall as a category, looking out the next 10 years? Absent from QED, I expect QED will do just fine in this environment, but more broadly, my own perspective is that there's a lot of money in the category, and excess supply of capital relative to a finite number of quality opportunities means valuation goes up, and therefore subsequent returns goes down. Obviously, different subsectors in venture will perform better than others. But how do you see venture overall, and then maybe subcategories that you're excited about?
Yeah, I mean, I wrote a paper that you mentioned about a year and a half ago called the three body problem. So if anyone's interested in a framework for thinking about, venture firms, I think it's an interesting paper and at least gives you a way of categorizing VCs and, what it will take for them to succeed. But the reality is, like, venture firms have two customers, and it's important to understand that they sit in the middle of this ecosystem, right? You have the LPs that are giving them the money to invest, and you have the founders, right, that are building the companies to invest in. And ultimately, a healthy VC firm has a product that works for both of those ecosystems simultaneously. And that's a problem, because if you actually were to be like give every VC a truth drug and had them evaluate like the structure of their VC, 80% of them would be in a technically bankrupt box because they're only serving one of the two parties. And some of them might be serving none of them. So, you have to ask and answer the question, if an LP had perfect information about performance, perfect information about skills, would they pick my VC first? And allocate money to the VC, I should say, to invest the money on their behalf. And at the same time, you have to have an answer in the startup ecosystem and say, if a right-hand tail founder with a right-hand tail idea had perfect information, would they pick your VC firm first if they had perfect choice? And if you're not a founder's first choice, then you're in the exhaust of the tier one firms. And if this is a power law game, like, you can make money like mining someone else's exhaust, but that's hard work. Like,
Absolutely.
really hard work. And, I hate to call it, and I don't mean disrespect, but looking for the cream of the crap is hard, right? That is harder to do.
Adverse selection.
It's adverse selection. It's easier to figure out how to become a tier one firm than to make it work as a tier two firm mining the exhaust of the tier one firms. And on the other side, it's the same with LPs. Like, you're actually seeing a rationalization happen right now, where they're starting to look at the strategies of the VCs and say, wait a minute, why would I give this firm more money when I have this firm over here that's doing really well? They're strategically positioned well. They can articulate what their strategy is and why it's going to generate, outsized returns and alpha. So you have to be able to ask and answer the question, like, why you exist in the ecosystem. A lot of the answers are really shallow.
Yeah, no, I agree. I think there's a lot there. The top quartile median IRR on venture is in the 15 to 18%. That's coming off a decade of strong performance. And that means that the vast majority of investors in venture are not getting the required return they should expect from an illiquid, high-risk investment. I mean, that 15 to 18% return should be the return for the 25th percentile, not the 75th percentile. The vast majority of capital investors cannot deliver that kind of return, including angel investors and funds that don't have the seasoning or the edge in sourcing or thesis-driven approach. And the other part is, it's a question of serial correlation. Do great funds in one vintage outperform the next? John Doerr was the hero VC when I was finishing school. I'd read the John Doerr books and interviews, and Kleiner Perkins is where he worked. And of course he retired, and Kleiner Perkins was number one VC, and they're a great firm, fantastic people, but it's just not the first call as it used to be. Sequoia has maintained that brand. They took a few dings with FTX. I think they'll get past that. I don't think that's really an issue. Your firm was created after, those firms, and, you're maintaining that. But how do you think about that autocorrelation in venture?
So thing number one, I can truly say I don't understand how to be a generalist and create a value proposition that absolutely has repeatability of performance, right? Again, the surface area you're covering is everything. And if you look at the Cambrian explosion of startups that are out there, like, how do you underwrite everything? I just think about the work that it takes to understand an ecosystem and to understand a founder and to understand like the context. And again, it's the only way I know how to do the job. So it's hard for me to imagine being a generalist and tomorrow being asked, go look at a, enterprise software company that sells into telcos. Like, I wouldn't even know where to start, right? It would take me a year to just feel comfortable with the language that people are using. Because, by the way, founders are incredibly charismatic and they will convince you of things if you actually don't have the ability to understand the ecosystem as well as they do.
Specialization matters. And you also futurecast too. So not only you are focused on a category, but you have a thesis, you have a vision. Of course, that's being informed by founders you talk to as well that might or might not align. But I think that's another distinction that you introduced.
But by the way, there are individual investors who are incredibly good at being generalists and succeeding over and over and over. The question is, can you assemble a firm, that can outlast the individuals? Like, can it be a generational firm? Like Benchmark is an incredible example. I adore the people at Benchmark. But the entire model is contingent on how good are they at replacing a genius with another genius. Like it is literally one in, one out. It is about talent. It is about making sure that you have the most insightful people that literally can spot, the winners incredibly early in a generalist context. I don't know how they do it. I couldn't do that job.
One of the founding partners was a former recruiter, which may play a role in the talent. But no, your point is well taken. Within fintech, what are the subcategories that are underrated or overrated? There's a lot going on from payments to lending to, Web3, stable coins, wealth tech. What's intriguing you?
So not a surprise. I mean, with 20 some odd investment professionals and a surface area that is global in nature at this point, there's a lot that we're looking at. Almost every investment, in fact, every investment professional has multiple theses that they're paying attention to and an area of expertise that they're focused on. So we probably have 40 or 50 different, things that we're paying attention to, and almost keeping our eyes open and being receptive for a business that we hope ends up coming into existence, right? That will solve some of the problems that we're identifying. To be a little bit simplistic, there are a couple themes that I think are incredibly interesting that are crossing multiple partners within the firm. Some of them are going to sound very generic because other VCs talk about them, but I think there's a nuance in finding the right ones. So, enterprise SaaS that monetizes through fintech is a really interesting concept because new operating systems are being built for almost every vertical. And, once you create the new operating system, once there's a new way of doing work in an industry, the big pillars of banking all of a sudden come to the front of the value proposition and how money is made. So for almost any ecosystem, money needs to be moved. And a lot of times it has to be moved in a very specific way. A lot of times there's an advancement of money or a borrowing of money that's necessary in order to create capital efficiency for players in the ecosystem. Sometimes there's custodial services. Right. There are things that happen. Sometimes there's insurance that needs to be layered on top of things. So we have a business that, intersects transportation tech and fintech, right? That it's a company called Nuvo Cargo that all they do is help trucks get from Mexico to the US, right? And they built an operating system for the trucking companies to schedule the trucks, to get insurance, on the various trips. To move money back and forth, convert the currency from, pesos to dollars. Like there's a lot of fintech that's embedded in that, but it starts with how do you get trucks from Mexico to the US? Here's our operating system, right? I sit on the board of a company that's at the intersection of music and fintech, right? Every single song has a cap table, And the cap tables have historically been in contract form sitting on someone's desk. And every 6 months, they'll look at all the payments that come in and say who gets paid what. Well, guess what? 85% of all earned money in music now comes through a digital source. So if you can actually host a cap table for each song and connect to the digital sources, you actually could have real-time payments going to creators.
Incredible.
Right. And, so many of these new artists, like they're trying to make a living for themselves. And if you have to wait 6 months for payment, like it's a really big deal for them. And advancing that money real time is important. So again, vertical SaaS with fintech put on top of it, I think is a very, very interesting theme.
I like that. Those are great categories. On the music and fintech, you touched on a concept that I'm very passionate about, which is how do you enable creator economy and crowdfunding of artists that are building fan bases via social media and enable investors, namely their fans, to both underwrite because they know them best, 2, promote because they're fans, and 3, participate in the American dream and unlock that. And it sounds like you've got a very exciting business there. I personally would like to see crowdfunding laws upgraded so that you can enable NFTs to interact between the artist and the end user and help to manage the payment and the syndication flows.
Yeah. And the company's name is STEM. And they are a data analytics company as well that can analyze the future revenue streams for songs because they have decay curves. So when an artist actually, makes music available on all of the major platforms, you can actually watch with data if it's being added to playlists. You can actually use the data to figure out how often it's being played. Is it being played more often? Is it being picked up in movies or in TV shows, right? In kind of sync work. So there are all these things that can happen that go into what the decay curves look like on how much revenue is going to come in over time. So they can actually advance money against future revenue streams. And they can actually arm fans with the data if eventually, there's monetization of these streams out in a crowdfunding, type of way. They could be the data analytics platform that powers that. But it starts with information. It starts with APIs and connectivity, like all of the things that have been playing out, in the past 4 or 5 years in the fintech world. And then you layer a payment stream or a royalty advance stream on top of it. And that's where fintech comes in.
Right. It's the evolution, right? It's this continuation of embedded finance where, say, the 2010 to 2015 was own the customer, develop a brand, develop a neobank. And the ideas that you've identified here are about the behind the scenes enablement. In your first example, you've got a trucker who needs an open table like reservation tool to manage where they've got to be, but you've identified a financing or payments opportunity there. And similarly with the music and the fintech opportunity.
And for the truckers, they need insurance. They need bank accounts. Like there are a lot of things they need, and becoming the operating system is a good step one.
Right. Any thoughts on AI, digital assets, crypto, and then we'll talk about how you manage new buzzwords that come up.
Yes, I mean, look, any new technological development creates an S curve where the companies that end up climbing that S curve and sitting at the top of it, 3, 5, 10 years down the road, end up capturing a lot of value. And, the question is what that S curve looks like, who is actually climbing it, what the competitive set looks like, and how much noise there is relative to signal, right? So I think it's a well-known statistic, but I mean, if you look at the search wars, in the early days of the internet, something like 97% of all of the enterprise value creation could have been captured post Google going public. Right? The amount of money that was lost in figuring out who was climbing the S curve and who was going to win that battle. I mean, massive amounts of money ended up getting wiped out in the venture world.
Say some more around that. Are you saying that you said that after the rise of Google, 90%? Go ahead.
Yeah. So they climbed the S curve and they ended up being a winner. but the category was so large that once they were a winner, they continued to grow. And the value was captured in the public markets, not in the sausage making.
Gotcha. So betting on Google, right? The upside was after the Google IPO, after the winner had been identified.
So in AI, as an example, like we all know how profound the shift is. And
Right.
this is something that I've been waiting for over 30 years. I actually studied AI in college. My school is paid for by the Jet Propulsion Laboratory, and I wrote code that went up on the Mars Explorer mission. So, I mean, this is something that I've been watching for a very long time, and it finally feels like AI is at a point where it's going to make a very large difference, and it is a new platform. It's a platform shift. But the problem is, like investing at this point, there's a lot of noise, not a lot of signal. It's going to create confusion in the market for buyers of products. The cost curve is collapsing very, very quickly. So if you're investing in a company today, it will cost you more to get answers to questions than a year from now if you ask those same questions. So the question is, are you generating durable enterprise advantages faster than the cost curve is coming down for the next people to come in and build on top of the successes that have been discovered? And that's a really difficult thing when, a lot of what you're investing in today isn't software, right? So if you're investing in an AI company, you're not necessarily investing in a lot of software, you're investing in compute. And that compute cost is coming down by, make up a number, 10x year over year. Like it's coming down incredibly rapidly.
Yeah. Right.
So, if it would cost you $400 million to train a model today, it might cost you $4 million to train that model 2 years from now. So unless you can create durable advantage over this 2-year period, you might as well wait and figure out like what the world looks like when compute comes down. And there will be winners, right? There will be someone that actually does create durable enterprise value in the meantime. It might be incumbents though, right? This is a platform shift that's very different than other platform shifts. A lot of platform shifts, the platform was so different than the platforms that came before it that startups had an advantage over incumbents. But in this case, it really is about compute and it's about APIs into big LLMs, which is one aspect of AI. There are a lot of other things going on in AI. But a lot of big companies understand APIs. A lot of big companies understand compute. They understand data centers. They understand buying hardware, right? So even though it's a platform shift, at the same time, it's a platform that's actually very accessible to incumbents. And you're seeing it with the likes of players like Adobe. Like Adobe is going to do incredibly well with artificial intelligence. And it might capture opportunity that otherwise would have been available to the startup ecosystem with the advantage of a very large embedded customer base. And they can afford to overpay for compute now because they have a core business, that's subsidizing it and they don't want to lose their lead. So again, I actually think there's a lot of promise. And, if we had a lot more time, I would talk about how bad carbon-based learning machines are, i.e. human beings, and how good silicon-based learning machines are, and some of the problems that they really can tackle because it can overcome how bad, we are as learning machines.
No, absolutely. No, I agree. I think AI creates an event horizon. The velocity of change is so high. And as you pointed out, there's a trade-off between the cost curves coming down and what you learn per investment. It's another good Frank Rotman framework here. So I think we've covered a lot of ground, Frank. Is there any concluding remarks? How can people stay in touch and learn more about you or QED?
Look, I joke about this, but I complain a lot online under Fintech Junkie, which is my Twitter handle. And it seems to be that people like what I write because I try to share insights on conversations that I'm having regularly with people like you or founders. And if I'm writing about it, it's because I'm probably discussing it multiple times, which means it's a current issue. So if you're interested in finding out more, feel free to follow me. I respond, if people are interacting with my tweets. So I don't go dark. And we're very easy to find, QEDinvestors.com. We list all of our companies. We have a lot of the material that we publish, on the site. So people can go directly to QEDinvestors.com and find more.
Terrific. Fintech Junkie on Twitter. Great follow. Thank you so much, Frank. We'll have to do it again soon. Have a good one. Take care. Be well.